Welcome, everyone. We are Hunter Housing Economics, and today I have, as last time, Audrey Herrero, formerly Audrey Carlson. And Audrey has a fantastic background in BTR. She's looked at hundreds of deals all around the country and looked at it from the standpoint of deal metrics and so on. Really glad to have Audrey here with me. And so we're just going to have a little conversation. One of the things that I have been always looking at is the demand side of things. And I'm really impressed with how strong rental demand is right now. We saw on the multifamily side, even we saw all these units that were coming to market last year and this year, and the demand has been there to absorb pretty much all of them, with few exceptions. So it's interesting. The job numbers right now are bad, but the demand is strong. And we're expecting 360,000 or so, 370,000 new renter households per year nationwide over the next 5 years. And that's going to lead to pent-up demand because deliveries of BTR are dropping like a rock. We're going to be down to 20,000 deliveries, fewer than 20,000 deliveries in 2027. That's half of the number that we saw delivered in 2024.
Yeah, I think it's super interesting. And especially when you're looking at the differences between the build for rent and single family rental industry versus the multifamily rental industry. Sometimes that data gets lumped together, but it is very important. They're two very different product types. And I think just looking at all the markets we've been doing market studies in, we've found that the build to rent and single family rental rent growth has remained positive in most markets, except with the exception of Austin or a Phoenix and some of those overrun markets. But it is interesting to see how stable that rent growth has been. Whereas, yes, there's still a ton of demand for the multifamily units, but with so much new supply, I just saw some interesting data Jay Parsons posted on LinkedIn talking about how this is the first summer in 2025 that multifamily rents did not increase. And the thinking around that was that there's just so much new supply on the market that renters have so many options when they're deciding where to lease. So there's still a ton of demand, a ton of pent up demand. And so these units are being absorbed, which is great news for the market, but it is spread a little bit thinner. And so rent growth is taking a hit on the multifamily side.
Yeah. And on the BTR side in certain markets as well, we're definitely seeing that in our studies. There have been some rent declines and some flattening of rents. And that is primarily because of all of this rental supply that has hit the market at once last year and so far this year, but it's starting to taper off. And the big opportunity is over the next 2 or 3 years, where there's going to be very little being delivered, so very little competition. That's going to allow for more capture per project of that demand that's coming. And plus, there's the BTR pipeline, a lot of which is reverting back to for sale right now. So a lot of what we thought was in the BTR pipeline for 2026, 2027 isn't. And I'm going to pull up some graphs that I want to show that kind of underscore what we were just talking about. So yeah, I've shown this graph before. What this shows is the pipeline of deliveries. And so the BTR is in the darker blue at the very top of the bar, the bulk of the bar being multifamily, and deliveries of both of those have just started to drop like a rock down in 2025. BTR deliveries were actually down in 2024 pretty substantially as well, which doesn't show up all that well in this graph. But the important thing is to look at the deliveries. And when you look at in 2024, we saw 36,910 BTR deliveries, dropping to 33,000 this year, 27, and then, like I said, to fewer than 20,000 by 2027. And what that means is there is going to be this pent-up demand. That's a 48% drop in BTR completions, according to data from Yardi Matrix. So that just underscores that opportunity for building in 2026, 2027.
Yeah, I think that's super interesting. And as we've said, there's just going to be a huge pent up demand in 2027, 2028, where there's really no supply being dropped into some of these markets. I think that also goes to the conversation around where are these built for rent? It was initially back in 2021, 2022, the strategy was to build infill, to really build in these inner cities and try to meet the demand there. But as we've seen through the pandemic, especially, it's really pushed people outside of those inner cities into more of these suburban rural areas, which is really the ideal market for a build for rent, especially when these consumers are looking for more space. So they're moving out of a multifamily apartment and they're looking for either a townhome or a cottage or even a detached home with a garage. So it's super interesting to look at that. And we recently did a market study in a Northeast market where it was really interesting because when we initially looked at a smaller market, we were concerned because there was quite a decrease in population. And when we put our heads together and you're really just thinking about, okay, was this really brought on by the pandemic? Was this the move from the city to either a different state or to the outskirts? And so when you actually dived into the data, you found out that that lost population from the inner city was actually regained in the rural and suburban areas around that inner city. So, say 30 to 40 minutes outside of the main city. And so, what we can assume from this data is that a lot of people are looking for more space. They're looking to spread out, move out of their apartments, and also hand in hand, they're looking for lower rents, most likely. So, build for rent is primed to be able to provide supply for those consumers who are looking to drive 30 to 40 minutes outside of the city so that they can afford rents. And then also just thinking about how can build to rent developers play into that and really help out. And I think certain amenities like community gardens, I've really seen that become much more popular, and talk about a super low cost amenity that you can add in that's going to add a ton of value to your community, as well as trail systems, either internal within your community or connection to local trail systems and parks. Anything that really encourages that indoor outdoor living, helping people really enjoy the outdoor amenities that are there in the market.
And
Uh,
fences too. That's a
and
great point.
fences, absolutely. I think one of the biggest things in the shifts that we're seeing currently, and we're going to just see even more, is smaller houses with bigger outdoor areas. So whether that's a community outdoor area, more outdoor green space, or whether that's a fenced in private yard where people can have their own garden. Interestingly enough, I think it's very much a trend right now. A trend that's probably here to stay is Gen Z and millennials really wanting to become homesteaders. They want to live on their land, they want to spread out a little bit more. And so I think that just goes to show that build for rent is the perfect solution. A lot of people can't actually afford to buy their own farm or to buy an acre with a house on it, but they want a lower density solution.
That private outdoor space is absolutely critical. And that's the ultimate amenity. The house is the amenity, the yard is the amenity. And it doesn't have to be a big yard. It can be a rather small yard by single family standards. But if they have a little bit of space, remember that, and I'm talking to our audience watching, the majority of the renters in a lot of these built to rent communities have dogs. And so that's, you got to remember that is a key audience and you got to cater to them. And having a yard can sometimes really be a major differentiator. It is a huge differentiator from apartments. And we're just going to see a lot more people outgrowing apartment living and moving to this kind of environment. And back to what you were saying, Audrey, about the upstate New York study. We're still doing studies in Tennessee and North Carolina, Florida, and so on. But we're also seeing the Midwest. We're going to see a lot of, I think, activity in the Midwestern markets going forward. And I think that there's rather a good opportunity for developers to look outside the Sun Belt. I know that the vast majority of them are really confining themselves to the Sun Belt, and I understand why. It makes a lot of sense. But for those who want to diverge a little bit and differentiate a little bit more, the Midwest and the Northeast make a lot of sense.
I absolutely agree. And many of these markets that have been untouched by most build for rent developers, like the Midwest and the Northeast, they are delivering into markets with zero competition. Some markets have not even a single build for rent, or maybe they only have a handful of build for rents that are slightly older. So, what an amazing market to be able to deliver in and know that your absorption is going to be super high just based on the demand we're seeing in those markets.
There are risks associated with small markets, so you have to be really careful. I think the best development deals are going to be those where there's a big delta between rent and cost to own. In a lot of markets, it's $800, $1,000 a month. And so I think that's one thing to bear in mind. Also, with the small markets, there are risks, specifically the rents that you're going to be looking for are probably unprecedented in that area. Three or four entrants all coming in at once could somewhat collapse the market for a period of time. And then can you get rents that are sufficient in that market to cover today's cost of construction? So you got to think deeply about those kinds of issues. But if you do, and you're willing to kind of zig while other people are zagging, that could be a good contrarian play.
Yeah, and I think that you make a really good point there talking about rent, especially in some of these smaller markets. I think it's assumption that you can come in, you can bring a better new construction product, and you can charge way higher rent than what's currently being charged. And the reality is, the residents in that area likely aren't going to be willing to pay that huge inflated rent. So it's how do you find almost that missing middle, making sure that you're providing attainable rents and an attainable product. And so really what we've seen the solution to be and what we've been talking about for a couple of years now is making sure that you're building a more efficient floor plan. For example, when you're looking at a 3-bedroom, which is a huge unrealized opportunity in the build for rent market and just in the rental market in general, there's a lack of these 3-bedroom homes. We really like to see between 1,300 to 1,400 square feet. And to a lot of people that may sound surprising, that's very small, but we've seen it done very well. And so the floor plan is still highly functional, except you have a lower build cost with building less square footage. And you still have the 3-bedroom home, or in some cases, go up some square footage and build a 4-bedroom home. And that's super desirable for these residents, but they don't want to be paying $500 extra for this 3-bedroom home. So really just keeping these small little floor plans, and then you can still offer what the market is asking for.
That's right. And we've seen again and again the proof in the market that people will pay a premium for that third bedroom, even without increasing the square footage. At the wall, create the extra bedroom, people will pay for that. Not that there isn't demand for the dinks out there that are looking for a 2-bedroom. That is still certainly a viable market, but in a lot of cases, it does make sense to go ahead and go 3-bedroom and sometimes even 4. We've got a client in Nashville that loves doing 4-bedroom. So it just depends on the market and your own internal strategy.
Yeah, and I think what is there's such a high demand for these 3-bedroom units, especially in markets that are only currently offering studios 1s and 2s. And so we've seen a very quick absorption, even at a slightly higher rent for these 3 bedrooms. And at communities, just calling around and talking to these leasing agents that are in either traditional multifamily communities or build for rent communities, is when they have a very little supply of 3 bedrooms or they don't offer 3 bedrooms. That's one of the most asked questions by shoppers coming to their community is, hey, I want a 3-bedroom. You don't have any available. Where can I go?
That's right. One of the things that comes to mind too is in our studies, we're of course always told, look, that the finance partner doesn't want any trending. So got to just stick with today's rents. But at the same time, our studies are about forecasting and we're economists by nature. So we're going to forecast, we're going to forecast demand over the next 5 years, splitting that demand into 2 kinds of demand, the demand from new households that are going to be formed in that primary market area over the next 5 years, plus move up demand from people that are already living in that primary market area that will move up to this newer, better product. And then you've got to look at the supply demand dynamics and the way they're changing and whether or not the finance partner really fully takes into account the idea that rents can go up faster when we're only delivering 20,000 units nationwide in 2027 or not. They're going to take into account some of it. And I think that's okay. And any little bit helps. And I think just making that argument and making it clear and showing the data to illustrate that point is very powerful. Plus, like you said, optimizing in our studies, especially with your work, Audrey, we help the client to optimize the project, and that helps them to optimize the rents and maximize the rent that they can collect.
I think that's going to be the biggest value add, especially when you bring to the conversation, talking to these equity groups and trying to make the case for bringing build for rent into the market. What kind of rent growth can it potentially get? I completely understand wanting to underwrite a much more stable rent growth. And right now, that's reality. That's what's going to be most reasonable. But just bringing in, yes, what does the economics of this market look like? What does the supply and demand of this market look like? And what can we assume from that? But also, what additional value can you build into your community so that you know without a doubt that your community is going to stand out in the market? If you're building the exact same products that everybody else is building or has built in the past, I understand an equity group saying, why is yours going to achieve this 5% rent increase that you're underwriting into your model, right? So if you really look at what design are you building in? So what do some of your finishes look like? You can choose different finishes, whether it's a different color or a different design that isn't going to increase cost, but it's going to add a unique element into your home that shoppers are going to come into and be like, oh, this is different from everything else in the market. And that's going to increase your absorption. And so I think it's just thinking of these little low cost solutions that you can build into your home that are thoughtful and are going to increase absorption, which is going to be better for your bottom line.
Yeah, that's right. And we also recognize that the economy is unstable in certain ways. There's a lot of uncertainty, a lot of big policy changes happening, and with potentially unpredictable consequences. And how do you think that operators are dealing with this kind of uncertainty? How are they factoring that into their project management strategy, retention? I know that a lot of them are really prioritizing retention right now.
And as they should be, I think you really need to, as a property manager or a build front operator, you need to be investing and doubling down on your consumer retention strategy, right? So making sure that your customer service is top tier, that you are doing everything to keep these residents in your community, whether that means offering unique perks to live there or just making such an easy and enjoyable experience for your renter that they don't want to move all their stuff and move to a different community. I have heard in multiple markets that we've been doing studies in, just talking to the leasing agents, that one of the biggest reasons renters are moving out of their communities is high community fees. So that's always been a conversation in the build for rent market, just because it's very typical in multifamily that you're charging this amenity fee or a community fee on top of your rent. That can be extremely unattractive to a renter, especially when they have to be a little bit more cost conscious because they're feeling the pinch when it comes to living costs. So I think anything that you can take off the stress of your residents, that's going to be huge in your PM strategy. And then I was just saying, with kind of this unstable market, I think we've absolutely seen a lot of consumer PTSD in the home buying world. So they either bought a home when the interest rates were super low, and now they're having a hard time selling. I just saw a Wall Street Journal article this morning talking about somebody who bought a home in Atlanta, and they have had it on the market for a year and they cannot sell it. And so people that are wanting to move can't move. And I think that's creating this stress in the industry that they just want to get back to being a renter because that's the most stress-free experience. So think about that as a build for rent owner operator, and how can you make that the most stress-free, enjoyable experience?
Yeah, that's a good point. And a lot of people who are renters by choice are renting because of the convenience of it. Make everything as convenient as possible. Put a lot of thought into that. I think that's a really good advice. And yeah, there's definitely a big debate among developers and operators in BTR as to whether to go for that non-rent income or build more of it into the lease rate. And I think different developers have different strategies. And I think that there's room for all kinds: pet fees, tech fees, amenity fees, lease breakage fees. And, but I think that the importance is clarity too, just being clear with that tenant or prospective tenant so that they know what they're getting and know how to compare.
Absolutely. Anything else that you want to cover?
Last point, there's this conundrum or confusion or seeming contradiction where people say, oh, there's this shortfall of rental supply, but there's all these stories about oversupply and falling or stagnant rents. And so I think that we have to kind of explain that. And one of the things that's going on is consumers are pinched, especially young people with student loans and so on. And so they would like to have their own place and maybe they just can't manage it right now. The other thing that's going on is geographic. So places in Texas certainly do have an oversupply problem, but that's going to change in 18 months. certain parts of Florida. Florida is really a mixed bag, right? A lot of markets are struggling and others are doing extremely well. When it comes to migration statistics, a lot of people are talking about the domestic migration numbers being down now that there was that surge during and after COVID, and then Florida started to go down. But you have to look market by market because you can't paint the whole state of Florida with one brush. Markets like the Space Coast are still seeing very strong in-migration. Fort Myers is down right now because of the hurricanes we had, as well as other kind of factors that are in play. Arizona, I think, is another one that has had some issues. However, we've done studies for BTR in the Phoenix market, even in West Phoenix, and the market's really not bad if you're approaching it right and hitting the market with the right product. I know that you were heavily involved in our last Phoenix study.
I think that's the key is the right products, right? You can talk about that in every different way, but it comes down to if you don't have the right product, your community may not operate how you're underwriting it to. It's really what I'm trying to say is we're lacking the supply that is actually fitting the bill for the consumers. We're lacking the supply that consumers can afford, that they desire, and that's the type of products that they're looking for. So whether that's a 2-bedroom or a 3-bedroom or a 4-bedroom, it's also, is it the right square footage or do they feel comfortable in the design of your interior? Or do they feel comfortable with having a backyard or not having a backyard or having a garage or not having a garage? And so that really comes back to making sure that you know your market inside and out. You know what's currently being offered there, how those products are performing, and then how are you going to come in and basically supply what's missing in that market or what's in the highest demand and not being delivered.
And a lot of our clients are asking, how do we address the underlying problem and still make money? And maybe part of the discussion for some of them, at least, is do they offer fewer amenities? And like you said, optimize that bedroom count while still managing the square footage to keep construction costs as low as possible. And I think that it depends on the type of product. The cottage style is definitely going to still need a lot of amenities, but some of the other styles that really have very few shared walls or no shared walls, and they have attached garages and so on, they are so well differentiated against apartments that they can probably get away with fewer amenities now. So it all
Completely agree.
by case.
Yeah, completely agree. And I think it also talking about how you're designing your products, but also how it's laying out on the site. Are you doing multiple different product types? Maybe you're combining townhomes with cottages, with potentially even apartments. We've seen that on
Yep,
multiple
that's right.
communities that seem to be like a really good strategy just based on what's in the market. For example, the West Phoenix study, they were taking a look at cottages with garages and without garages on the same site, combined with stacked flat apartments. And what that does for a community like that is it really creates the marketability of the rental rate. So now you can say rent starting at this low rental rate because you're offering apartment units, but that can range up to a more larger, spacious, livable product like a cottage with a garage and a fenced backyard that may appeal to a larger tenant base and therefore increasing your absorption, right? So if you're offering the 1s, 2s, and 3 bedrooms of varying product type, you're basically expanding your potential tenant base.
No, I think that's a key strategy, and we're seeing more and more of that around the country. Thanks for joining us today. We're going to continue to monitor all these trends and changes in the market. Reach out to us if you have any questions of your own, and we'll see you next time. Thank you.
Thanks, Brad.